During the quarter, we added 2 new names to the portfolio, expanding the invested position. We added Lotte Confectionery, which is a Korean confectionery company, but also a company that is expanding its presence across the Asia region. We're really attracted to that business. First and foremost, it's strong brands, strong market presence, not just in Korea, but in some of its offshore markets. And also it's very strong distribution presence, which we think longer term protects its position. One of the other things that attracted us to this business was its investments in other Lotte businesses. So about 80% of the market cap of this business is made up in cross shareholdings. Longer term, we think increased dividend payouts in a market like Korea, Lotte Confectionery will be one of the biggest beneficiaries of that. The second name we added to the portfolio was HSBC through its Hong Kong listing. Everyone knows the HSBC business, but it's got some very strong franchises across the Asia region. This name was added for slightly different reasons. We think the downside protection in the HSBC name is quite solid. Currently the business trades at a price to book of 1 time. And we think that the 5.5% dividend yield that you're getting on this business is a very good alternative to cash. Despite the moves we've seen in the Australian dollar over the last 12 months, we continue to maintain unhedged position with our major currency exposures being that of the US and Hong Kong dollars. We think despite the moves that you've seen, the Australian dollar will continue to come under pressure over the next 12 to 18 months. And we think there's 2 main factors behind that. Obviously, the first being the commodity cycle and commodity prices, and the second being interest rate differentials with the rest of the world. Firstly, on the commodity side, we continue to think that the prices of our major exports, primarily iron ore, will be pressured going forward given the return on investment that we continue to see from first quartile producers. The Rio Tintos and BHPs of the world continue to make very good money at $50 iron ore. So we think these type of levels will continue to be maintained. Secondly, on the interest rate differential side, we expect that over the course of the next 12 months that will continue to contract for the Australian dollar, putting pressure, downward pressure on the Aussie dollar. We've had very strong markets in Asia over the last 12 months, particularly in the Hong Kong and China markets in the last couple of months. Those moves are making it slightly harder for us as fundamental investors to find new ideas and allocate capital. If we look at what's driving the markets up in Hong Kong and China at this point in time, we think a lot of the capital flowing into the market is momentum driven, and that worries us. So what we're trying to do as investors is look outside of those markets for new opportunities. So instead of focusing on the Hong Kong and Chinese markets, we're out there looking at the broader universe, the broader Asia region, Southeast Asia, Korea, Taiwan. And we think some of these markets have been laggards and potentially opportunities will present themselves there. We're cautious on Hong Kong and China, but we still think there's a lot of opportunity for us across the entire region.